I don't know if you remember this. Not too long ago, I was talking about the Mag 7, including Apple, Meta, NVIDIA, Amazon, Tesla, Google, or Alphabet, if I might say, and of course, Microsoft. I wanted to run 3 sets of data on this for you so you could take a look at it. From strongest to weakest, still call this data set 1. Meta Platforms is the strongest. You can see Apple is in the top 10% of its one-year highs. Amazon, NVIDIA, Microsoft, Tesla, all trading just about in their top quadrant, 1/5 of the quadrant. But then you look down there at the bottom, there's Alphabet. Alphabet is 40% off of its one-year highs. Data set 2, volatility risk. We take a look at the options here, and I wanted to look at the short-term options because we will be going into an earnings set here within the next 30 days as we hit Q3 earnings. As you can see here, it flips around a bit. Tesla has the most volatility of the group. Then Apple, NVIDIA, Meta, Microsoft, Alphabet, Amazon down at the bottom. I mean, you take a look at this and you see nearly a 35 percentile here for Tesla and a 2.75. If I were looking for options in the Mag 7 that were the cheapest, I would be looking at Amazon.com. Finally, data set number 3, correlation. So we take a look at this and we see in the last 60 days, what's correlating the most with the SPY? When you take a look at that, you'll see Apple. About 80% of the time, 79.5% of the time, Apple was moving lock and step with the S&P. Then that drops to 70% for NVIDIA, 58% for Tesla, 56% for Amazon, 50% for Meta, 48% for Microsoft. And take a look at this. Google, only moving about 18.5% of the time with the S&P 500. All right, I want to show you those 3 data sets because I want to talk about why not, instead of trying to figure out which one of these is the best one to trade going forward, instead of trading the needle, which is the single stock, why not trade the haystack? The majority of all of this and more is built into the technology ETF. A little bit about ETFs right now. They're exchange-traded funds. They track an index or a basket of stocks. And just like an index fund, they also, you can trade them in your equity account. They also have options, the majority of them. Many strikes, many expiration dates, and you would use them, or I would use them the exact same way I would use a stock. Now, you know, all of you in here know how I use these. I usually go back to my foundational trading, which is not only taking a look at the charts, but looking at the seasonality. Take a look at the chart for XLK. You can see that it too has had lower highs and higher lows. The areas of resistance for XLK, 228, 238, and 250 would be that round number move if we were to move that high. The question is, with everything looking good seasonally in terms of SPY, TLT, SPY, DIA, QQQ, the index all looks seasonally healthy going into the end of the year. What does the technology index tell us? Well, when we look at XLK, the money counter outlook looks good too. 90% over the next 57 days. It averages a 6.5% return, much better than the overall Dow Jones, S&P, even QQQ. All right. Power meter was much higher, and this takes us from now out to around December 11th. Now, again, what can we do here? We could simply buy the XLK between now and December 11th. We can also look at options that expire in December. These are the options this morning that we're looking at. And, you know, you're looking at like the 225s. Those I want to call the at-the-money options. This morning, they were at $11.35, all the way out to the 245s that were $3.35. We can simply buy call options if we believe that we see that XLK making its move above 240, making its move into that area of the mid 240s. If we see that, then we possibly could see a double on this particular trade. If you don't see anything like that, maybe you say, oh, maybe it's going to go to the mid 230s, then perhaps spreading that might make sense. But if we were to buy these call options, the risk graph is going to look like this. You've got risk here of what you're paying for those options. You've got the break even, which is what? Strike price plus premium. That's going to put you up here around the mid 230s. And then you've got reward above that, and this is all at expiration. So to get a double on this trade, you're going to need to get, in order to get about 23 points, you're really going to need to see about 238 on the XLK. Absolutely doable, right? But again, we're looking at options that expire on December 20th. Those actually go out past the pattern that we're looking at here. So, takeaways on the haystack. Well, ETFs have liquidity that is at least, if not much higher than most single stocks. So you are definitely a small fish in a big pond here. You've got diversification because you're diversifying away from any single stock risk, which is that unknown risk that we hear from single stocks on a day-to-day basis. And of course, we can take ETFs and options on ETFs and use our rules-based strategies for these.